to Economic Insights. I'm Alex, and joining me as always is Selim, our market veteran and show producer. Selim, this week was absolutely wild. I mean, gold hit $5,600 an ounce and then crashed. What happened?
Alex, wild doesn't even begin to cover it. This was one of those weeks where markets whipsawed so violently that traders probably needed seatbelts. We saw precious metals hit record highs midweek, then crater by Friday. The trigger? A Fed chair nomination that sent the dollar soaring and crushed the gold rush in spectacular fashion.
So much to unpack. Let's dive in. Take us through what happened with gold and silver. I saw headlines about gold crossing $5,600 for the first time ever.
Right. So early in the week, we had this perfect storm for precious metals. Gold blasted through $5,600 per ounce, driven by geopolitical jitters and a collapsing dollar. The dollar index hit its lowest level in nearly 4 years after President Trump said he was comfortable with a weaker currency. Silver followed gold higher, reaching new record highs midweek.
And then?
Then came the reversal. Late in the week, reports surfaced that Trump was nominating Kevin Warsh as the next Federal Reserve chair. Warsh is a former Fed governor, perceived as an inflation hawk. The market took this as a signal for a stronger dollar and tighter policy ahead. The dollar surged, and precious metals got absolutely demolished. Gold dropped nearly 9%, silver plunged around 27%. They called it a whipsawing reversal, and that's putting it mildly.
27% in silver? That's catastrophic for anyone who bought at the top.
Exactly. And here's the kicker: Bitcoin, which loves to call itself digital gold, also slumped to fresh 2 month lows. Massive ETF outflows, liquidations everywhere. Bitcoin has now dropped 60% in value relative to actual gold, well, before gold itself cratered. I guess when things get scary, investors want the real thing, not code on a blockchain.
What else moved markets this week?
The Fed kept rates on hold midweek. Chair Powell described the economy as moving at a solid pace, but noted inflation remained somewhat elevated due to tariffs. He said the committee was well positioned to respond to risks, but gave no guidance on rate cuts. Translation: we're in wait and see mode, perhaps the only boring time in the markets. Elsewhere, the Bank of Canada also held rates steady. In Japan, the yen saw volatility early in the week due to intervention fears, but inflation data later showed Tokyo's consumer prices slowing, which took pressure off the Bank of Japan to hike immediately.
And equity markets?
Tech earnings were a mixed bag. Microsoft had its worst day since 2020 after reporting higher capital expenditures and slowing cloud revenue growth. Meta, on the other hand, surged on strong ad revenue. Apple posted solid iPhone sales with a rebound in China, though they warned of rising costs. Tesla announced big investments in robotics and AI, which the market liked. The S&P 500 hit new record highs early to midweek and stayed resilient despite the Microsoft slump. Korean markets rallied despite US tariff threats, while Indonesian stocks got hammered late in the week over concerns about MSCI downgrading them from emerging market to frontier market status.
Geopolitics didn't help the markets either.
Not at all. Oil spiked midweek after Trump mentioned a big armada heading to the Middle East, raising fears of a strike on Iran. Trade tensions escalated with threats of increased tariffs on South Korea over trade agreement delays, and 100% tariffs on Canada over its dealings with China. There was also a government shutdown scare, but by week's end, the White House and Senate Democrats reached a tentative deal to avert it, though a brief technical lapse is still possible.
Let's talk about Kevin Warsh and what his nomination means for the Fed.
Warsh is fascinating because he's perceived as a hawk, but his recent remarks align with the administration's preference for lower rates. He's a former Fed governor who's been critical of the Fed's data dependent approach. He thinks policymakers react to past noise instead of looking forward, and he wants less Fed communication overall.
So will he cut rates?
Here's the thing: most analysts don't expect a radical shift. Policy decisions depend on the full FOMC, not just the chair. The consensus is slowly shifting towards Fed staying on hold through the year due to sticky inflation and signs the labor market is repairing. Some institutions expect two cuts starting in June, but others think rates stay put all year.
What's Warsh's economic philosophy?
He's a supply side optimist. He believes artificial intelligence will be a major disinflationary force, a productivity boom that allows higher growth without stoking inflation. He also sees inflation as a choice made by the central bank, attributing recent inflation to excessive fiscal and monetary stimulus, not external supply shocks. Very monetarist. On the balance sheet, there's strong consensus he'll push for a significantly smaller Fed balance sheet and a return to Treasury only holdings, moving away from mortgage backed securities. He may also shorten the weighted average maturity by increasing the share of Treasury bills.
Let's review the U.S. economic data, shall we?
Real GDP growth for Q4 2025 is tracking at 3.0%, supported by solid domestic demand. Equipment investment forecasts were upgraded to 5.0% for the quarter, driven by data center demand. January non-farm payrolls are forecast to rise by 75,000, with unemployment holding at 4.4%. Core inflation is expected to rebound in Q1 2026, with core CPI projected to rise above a 3.5% annualized rate in the first quarter. Global core inflation has been stuck at around 3% for 2 years, defying immaculate disinflation narratives. Analysts forecast it to remain stable at 2.8% in 2026, though regional trends will diverge, US inflation accelerating above 3%, euro area falling to 2%.
Tell us more about Europe.
The ECB is expected to hold rates unchanged at 2.0% next week. The consensus view is that policymakers see this as a Goldilocks scenario, where growth is resilient and inflation is near target. President Lagarde is expected to maintain a neutral tone, emphasizing data dependence and maximum optionality.
And the euro?
The euro breached 120 against the dollar, reaching multi year highs, before coming back below that level. The appreciation, about 3% versus the dollar since November, is being monitored as a potential downside risk to inflation, but current levels aren't seen as requiring an immediate policy response. The euro's rally was primarily driven by broad dollar weakness rather than intrinsic euro strength.
What about Japan?
The Bank of Japan is moving toward a rate hike in April, driven by firming underlying prices. The yen experienced sharp volatility following suspected rate checks, and recent yen appreciation has reduced political pressure ahead of elections. Tokyo CPI data showed a gap between public and private prices, with subsidies suppressing headline figures, while private rents and goods prices remain firm. The upcoming general election is critical. Prime Minister Takaichi is seeking a mandate for responsible, proactive fiscal policy.
We covered the gold and silver crash, but what drove the underlying dollar moves?
The dollar weakness was dramatic. It's been characterized by what some are calling a $1 trillion diversification trade, investors reallocating capital from the dollar toward emerging market local assets, correcting a decade long period of underinvestment. The dollar has actually decoupled from US rates and economic data, correlating more closely with relative equity returns and global equity rotation away from the US.
And then Warsh's nomination reversed it?
Exactly. The sharp correction across precious metals was triggered by a rebound in the dollar and news of Warsh's nomination. Gold experienced a parabolic surge, breaking new all time highs before suffering a 9% reversal that took it back through the $5,000 level. Despite the pullback, gold still recorded an approximate 18% gain in January, approaching its sharpest monthly rise since 1980.
And silver?
Silver rallied more than 40% year to date, briefly surpassing $120 per ounce before slumping below to around $80 during the broader metals sell off. The metal is still expected to extend gains, with forecasts suggesting a price target of $95 per ounce by 2027. New policies in China regarding tax enforcement on overseas investments may be redirecting capital into silver. Chinese investors have been a dominant force in the precious metals rally, buying with such intensity that exchanges introduced measures to cool the market. Additionally, the Reserve Bank of India is set to allow silver as collateral for loans starting April 2026.
What about oil?
Oil prices climbed towards $70 per barrel, a 4 month peak, driven by escalating tensions regarding Iran. Prediction markets are indicating a near 60% probability of a US strike on Iran by March, though one might wager it happens sooner. After all, we had new Epstein files released this weekend. Severe winter weather and freeze offs in the US took approximately 1.9 million barrels per day of production offline at the peak in late January, primarily in the Permian Basin. Furthermore, China is expected to continue stockpiling oil, targeting an increase in strategic inventory to 2 billion barrels.
And copper?
Copper's in an interesting spot. A market deficit has arrived, supported by inelastic mine supply. Mine supply growth is forecast at only about 1% for 2026, well below trend. Price forecasts suggest a quarterly peak of $13,000 per ton in the second quarter of 2026.
Switching to emerging markets, let's start with the overall picture.
Emerging market currencies have appreciated significantly, driven by broad dollar weakness. There's been a structural shift of capital flows toward EM local assets, described as a strategic catch up after a decade of underinvestment. However, and this is critical, despite the favorable outlook for EM, crowded positioning is a risk factor. Coupled with a more hawkish Fed policy path, a near term sell off in EM assets is looking extremely likely.
China?
The Chinese renminbi has strengthened against the dollar but weakened against other major currencies. Daily fixings below 7 signal central bank comfort with recent strength, though domestic demand remains weak.
And India?
India's economic survey projects real GDP growth for FY 26 to 27 between 6.8% and 7.2%. The Reserve Bank of India is expected to maintain the repo rate at 5.25% and retain a neutral stance in its February meeting next week. Industrial production growth accelerated to 7.8% year over year in December. The Indian rupee has underperformed regional peers, slipping past 91 rupees against the dollar due to a wider current account deficit and equity outflows. A landmark free trade agreement has been concluded between India and the EU, eliminating or reducing tariffs on 96.6% of EU goods exports to India, including automobiles, machinery, and chemicals. The Union budget scheduled for February 1st is expected to focus on continued fiscal consolidation while supporting growth through reforms in agriculture, industry, and services.
Anything interesting in Turkey this week?
Banking Regulatory Board warned the local banks to stay away from spot FX transactions that mimic funding swaps, effectively cutting them out of cheap funding. While this initially pushed bond prices higher, due to fears of high January inflation expectations, bonds sold off, and rates moved higher toward the end of the week. Foreign inflows into government bonds and equities have been strong. Turkey's central bank is expected to maintain fiscal discipline and implement measured rate cuts, with a 100 basis point cut likely in upcoming meetings. Inflation is expected to re-accelerate in January due to minimum wage hikes and tax adjustments. Even though the story remains good, short-term vulnerability due to a general EM sell-off remains high.
South Africa had its rate-setting meeting.
South Africa's central bank held the repo rate at 6.75% in what is being called a dovish hold. Two members actually voted for a cut. Inflation forecasts were revised down due to currency strength and lower oil prices. Rate cuts are expected to commence in March, with the policy rate potentially falling to 6% by year end. Economic growth has been resilient, supported by strong terms of trade and recovering investment. The South African rand is seen as an attractive long position due to high yield and commodity exposure, though the rout in precious metals indicates vulnerability and heavy positioning.
South Korea and Indonesia?
Korea's National Pension Service adjusted its 2026 asset allocation to stabilize the FX market, reducing its target for overseas assets and increasing allocations to domestic bonds. This shift is estimated to reduce net dollar demand by approximately $15 to $18 billion. The Korean won is considered undervalued, with policy shifts expected to support appreciation. Semiconductor exports remain robust, though trade friction with the US over tariffs remains a concern. Indonesia has had a rough week. Foreign outflows from equities reached nearly $500 million in January due to fears of an MSCI downgrade from emerging market to frontier market status. The MSCI review cited concerns about low free float levels and shareholder transparency. Indonesian authorities responded by planning to double the minimum free float requirement to 15%. Despite the equity sell-off, the bond market showed resilience with robust inflows of $348 million month to date.
I know we don't cover Latin America as much, but there have been some developments.
Right. Brazil's central bank held the Selic rate at 15% for the fifth consecutive meeting, but explicitly signaled an intention to start an easing cycle at the next meeting in March. The committee removed previous language about needing significantly contractionary monetary policy for a very prolonged period. Consensus expectations point to a 25 basis point cut in March, though some analysts argue a larger 50 basis point cut is possible if the real continues to appreciate. Mexico's central bank is expected to hold the reference rate at 7% at its February meeting, marking the first pause since June 2024. Inflation projections are expected to be revised upward due to tax adjustments, tariffs, minimum wage increases, and World Cup-related price pressures. Analysts anticipate the resumption of rate cuts in May and June once the impact of recent tax adjustments fades, with the reference rate settling at 6.50% for an extended period.
What should we be watching next week?
Next week is packed. The main event is the US January employment report on Friday. Forecasts are for non-farm payrolls to increase by 75,000, with unemployment holding at 4.4%. We'll get JOLTS and ADP data earlier in the week to set the stage.
How about the central banks?
The ECB, Bank of England, and Reserve Bank of Australia all have policy meetings, and they're all expected to keep rates unchanged. The RBI in India is also expected to pause.
What else deserves our attention?
Big tech earnings continue. Alphabet and Amazon report, along with Eli Lilly, Novo Nordisk, and Toyota. On the data front, we get ISM manufacturing and services indexes, flash CPI for Italy and the Eurozone, and various labor market indicators throughout the week. Oh, and markets will be monitoring the outcome of the potential US government shutdown talks. The markets had not priced in a prolonged fight, but some signs are emerging that it can go sideways. That could inject some unnecessary volatility.
Sounds like another busy week.
When is it not busy these days?
Before we go, a quick reminder.
I know this one. Don't forget, folks, we do not give investment advice. For that, please consult a professional.
Thanks for listening, everyone. We'll see you next week with more market insights.